Day trading can be overwhelming and really complicated when you first start out. And so I want to walk you through the 7 reasons that took me from risking a small amount, not making money, losing money consistently, to now making consistent money, risking almost $1,000 per trade. It took me about 5 years to kind of figure out trading. And so I want to help save you that time and money lost with these key lessons that I learned. And towards the end, I'm going to share with you something that I've only recently really just discovered that has started to skyrocket by trading. Now, the first thing you often learn when trading is you hear that the trend is your friend and you should always be trading in the direction of the trend. So if you see an uptrend, you should probably be buying because the trend will continue higher. Now, what I realized is instead, the way to actually make money trading is you need to find an edge in the market. And the most of the time where I found that edge is actually in inflection points. And what I mean by this is you want to be finding out where the market is changing. Anytime the market is changing directions or modes, that is an inflection point. Anytime you see the market go from a sideways trend to a downwards trend or to a sideways trend to an upwards trend, these are inflection points and where there is an actual edge in the market. You do not have an edge in the market just buying in an uptrend thinking that it's going to keep going higher, because you don't know when that market is going to reverse on you. Now, you totally can make money catching swings for a while, but what I've realized is that's really hard to actually profitably do. And instead, looking for where those potential inflection points are in the market is going to make you way more money, because a lot of the time you can jump in on a trade, get out for a potentially high profit because there is a turning point happening in the market, which means there's an imbalance in the market. And so it makes it so the risk versus reward ratio is in your favor, to where a lot of the times you can risk something like, let's say $100, and you can make $300 or $400 in return. You're getting a 3 times or 4 times return. And so this is the way to make money trading, is learning how to spot where these areas are. And so the best way to take advantage of these inflection points is waiting for the market to come down to a key area of support or resistance or supply and demand, and waiting for that shift to change, because that's where there is a good edge in the market of a potential for that really good risk reward ratio, where you can get in this trade. I'm risking about $600, and then over the course of this trade I make close to $3,000. And so that's where the risk reward really comes into play and allows you to have an edge in the market and make money over time, because that's what trading is all about. Because that's the only thing we're trying to do when it comes to trading, is make money. And finding where those inflection points are is how you want to do it. Now, another type of inflection point is breakouts. Now, I don't personally trade these, and I'll talk more about why later, but if you have something like a resistance level here, you can see the market's bounced up here a couple of times, and it's eventually going to come up here and break it. Now, what happens when it does this is it can be a potential inflection point where the market, or whatever stock or chart you're trading, comes up to this level and the resistance area fails and it breaks out. The better ways to trade these is generally waiting for it to come back and test the level. You'll often hear this called a breakout pullback, where it kind of breaks out, comes back, and shoots up. And that's where the big trend play can be made. And so that's where you can see there's clearly an inflection point here. And that's another way you can make money trading. But the key here is you are focusing on that as a key level. Once you see the market kind of break out here, there's no place to get in. A lot of the times, a big mistake I did a lot of the time, and I see people do as I've started to teach this stuff, is that they will see this inflection point, miss this initial entry, and then they'll try and get in somewhere up here. Now you can see if you got in anywhere in this trend, in this case, you would have made money because it kept going up. But you don't know where you are in the trend when the market's trading right here. Right here, you don't know if it's gonna go up or down. It could go either way. And that's where focusing on these inflection points gives you that edge, because the risk versus reward is way more in your favor. Right here, you have the potential for the market to go up a lot, or right here, you have the potential for the market to break and keep going lower like it has done in the past. Now, one thing about breakout trades, which I want you to think about, is just because you see the market break out does not mean it's going to now continue higher in a massive way. Like over here, as the market moved up here, came into a sideways range, broke higher, made that pullback, and it kept going higher. So as we go forwards, we can see the market kind of does that again, where it makes a nice move up. Now it's going into a sideways range for a few days. We're actually looking at a 5-minute chart right now. And so you would assume, okay, we've broke up here. I'm going to wait for it to pull back to the previous highs, wait for that breakout pullback, and then buy it. And so you can see that actually worked pretty nicely to make new highs right here, but that doesn't necessarily mean you can now bet that, okay, well, it's gonna just make another massive move up. What the market will do sometimes, and this, when I say market, I mean any chart you're looking at. That's something I realized too, is if you can learn to read candlesticks, you do not need any indicators, and you can just apply it to any chart or market there is, because candlesticks just reflect that pure of price movement, and price always tells you what you want to know about the market. And so what happens here is what I like to call a fake out. Sometimes you can have breakouts and you can also have fake outs. And so this is something I actually realize as well throughout my trading, is when you see a fake out, it's actually an amazing signal of a reversal, because just like we talked about, if you think about it, you have these people over here that are looking for this exact thing again. And so they come up here, they see the market do this. You know, you think, well, we could be right here and I could expect the market to make a massive move up. And so they buy. And, you know, the trade, let's say you get in here, trade's looking good for a little while. And then all of a sudden, boom, the market just reverses. And so all those people are now trapped and they have to get out of their trade. And so it pushes the market lower. And you have people like me looking for this trap to happen, because it's pretty clear it works a lot. I would say this is the biggest signal I found for reversals, is these fake outs. And then it just makes a massive push lower, and it actually goes down to the previous level right here. That's something else I've actually realized over time too, is if you see a move like this and it kind of goes like this, if the market makes a very fast-paced trend and it starts to give that back up, it'll generally give that back up as a really good target is where it initially started, of where that trend up started. And so once this trend starts going down and starts breaking through this support here, I pretty confidently look at the chart and say, yeah, we are going down to here, because there is air between here and there. There's no clean support levels, because when the market moves so rapidly, it doesn't have time to be in a healthy trend and essentially stair step and make support levels as it goes up. When it just kind of moves up in one direction, it'll often, if it starts to give it back up, it'll just move down in one direction too as well. And so you can see that's what happens here. It starts to move down, thinks around a little bit, and then just pukes lower. Now as well, something that took me years to figure out, and it still might take you months to figure out and really learn, is the market has modes. Is looking and zooming out here, is the market has times where it's really good to trade and there's really good risk reward potential, and it has times where it just kind of sucks. And so, you know, you can see right here on this day, capturing a kind of move like this, that has insane good risk reward ratio, versus something like this over here. You can see this is a really small move and there's a lot worse risk reward ratio in terms of this move down. A day like this, you don't have as good risk to reward ratio versus this day like over here, where you can get in somewhere here and you can make a massive potential trade. And so the hardest part is learning how to decipher between days where the market is just chopping around, not doing much. You can see this day right here is the market was just kind of sitting around, really not doing much. And the way to really look at that is look at the candlestick. As you can see that they are just stacking on top of each other. There's no actual movement back and forth. And so even though the price here you can see is at a key resistance zone, it definitely can tell you though that there's just not much potential movement in the market. And same with kind of a day like this where, you know, the price here, it broke up and then just kind of sat there for a long time and then eventually kind of sold off, but it still kind of just sat there. And so you can see here that rule kind of applied again in terms of the market kind of made a big trend up here, kind of sat there for a while. And then once it started to give that back up, it gave it back very quickly. It started to find support there at that low area again. And so that's something really pay attention to because you can see that applies a lot. You can see it basically happen right here as well is shot up, came back to that area, found some support. And so how you decipher between kind of volatile days where there's good movement, like this day, great movement, and days where it doesn't have good movement can be challenging. And so this is where kind of experience comes into play, but knowing how to deal with that is really important. And so probably the biggest thing that took me years of just watching charts to realize was a timing in market. And so this is mainly focused on the S&P 500 or the NASDAQ or the Dow Jones, you know, mainly the key US indexes, is that there is a timing 30 minutes after the market opened. And so to show you what I mean, let's look at a NASDAQ chart on a 1 minute. And so I am on the West Coast of the US. And so the market actually opens at 6:30 for me versus the normal 9:30 standard New York Stock Exchange time. And so 30 minutes after the open is 7 o'clock for me. And so what I've realized at this time is this is when the big money comes into the market and will cause the market to shift in a big way. A lot of the time, the first 30 minutes of the market, it's kind of figuring out what it wants to do. There's potentially news going on. And so the big banks or whatever, you know, I don't really know what goes on in those places, but this is their timing for potentially starting to move the market. And what I often see happens, and again, it doesn't really matter why it happens. All that matters that it does happen. And so you can see at 7 o'clock, the market has sold off and now it's reversing. And that's my biggest thing I've realized is it basically, this is an inflection point in the market. It's where there's a potential edge to happen. And so on this day, market comes down pretty much around 7. You know, it doesn't have to be exactly at 7. You know, of course, there's some wiggle room in this. It's not exactly at 7. But I like to think about, you know, 10 minutes before, 10 minutes after, something like that. In this area, it's going to potentially have a bounce if it sells off into that area. And so this is one example. If I actually just scroll back to the previous day and we look at the market opening here at 6 o'clock, you know, the market rockets right at the open and then actually sells off, comes into our 7 o'clock window, finds some kind of support in this area. And then, you know, this one kind of takes a little while to get going, but it's pretty much finding that support at 7 o'clock. And then you can see from there, it just massive uptrend for the day. And so that's kind of where it's, okay, it's solidifying, it's finding its trend that it wants to do. And you could have easily come in here and put in an order here, put your stop loss below kind of this area and captured a massive potential move as the market moved up in this direction. Sadly, I wasn't trading on this day. I just don't trade Mondays. And so that's a rough opportunity to miss. And then another one is if we just go back to the previous day, again, this is kind of showing you how consistent this can be, is again here, 6:30, market kind of opens, it's kind of choppy. And then 7 o'clock, boom, it opens up, pushes the highs, and then starts a trend from there. And so this one isn't that great, I would say, because you can see again, the market's kind of choppy. And so going back to that rule of knowing, okay, when's the volatility? That's, you know, volatility gives you good risk reward, gives you that edge. And here, you know, there's just not really that much volatility. There is volatility back and forth, but quite often when I see that, I think, well, okay, it's choppy. It's just kind of moving back and forth. So it's more likely to keep doing this. I always find that the market is more likely to continue what it's doing. And so if you're ever not sure about a read or what the market's doing, just think about it's likely to repeat what it was doing. I don't know percentage, you know, I've heard 80% sometimes thrown out there, but you know, that's just kind of a random number. But again, versus this one over here, you can see there that boom, there's volatility in this market, way more And so then it comes down here. It does sit here to chop for a little while, but you can see that it's had this type of movement recently in the day, which gives it more likelihood for it to happen again. And so what all this has done for me is it has narrowed my focus trading. Now, one thing that really helped with my trading was switching to futures. And so this is a trade from years ago of me starting a smaller account with a smaller account of trading futures. Now, I used to trade stocks. I tried to trade options, even some Forex. And I realized that trading futures allowed you to start with way smaller amount, and then it allowed you to have a lot more flexibility as well. And the leverage is honestly insane. I think it's somewhere like 450 times. It might even be 500 times leverage. It goes up as the market goes up in price. And so it allowed me to start looking for these, reversal opportunities where I jump in on a trade here and then I capture a massive move down. And you can see here, I'm up $770 in this trade. And in this one trade, I think I was risking about $150. And so this is a massive win for my, smaller account that I was starting with at the time. And so I would highly suggest looking into trading futures if you haven't, because it's been super helpful for me. And I've actually realized there's a massive trend shifting towards them. I think as people realize how much more beneficial they are. And so I have a video that I'll link that goes way more in depth to talking about futures and explaining how they work, if you want to check that out. And so switching to futures were really, really helpful. And so what figuring out this 7-minute timing also did for me is it allowed me to really narrow my focus. The biggest mistake I see so many new traders do, and I did myself, was going into the market and being reactionary and saying, watching the market play out and seeing, oh, wow, the market's shooting up. Let me buy here. I got to get in on this move. Look how fast it's going. And, you're trying to essentially capture every move. And so, again, if you jumped in right there, you bought in right at the top, and then now you're seeing it go down. Okay, I got to get in. This is reversing. And then the market sits there, right? And so it's having 5 different strategies you're trying to do, or 5 different patterns you're trying to trade, and essentially trying to capture out on every move. It is not about capturing every move in the market. You don't need to be trading breakouts, reversals, continuation trades, scalping for smaller things, and then swing trading on a larger time frame. That honestly has kept me stuck in a cycle of losing for 5 years straight, because I wasn't focusing on one specific thing, and instead starting to just focus on, okay, I come in every day, open my charts, look at a larger time frame and see, okay, where are the big ranges in the market today? Looks like we have a big resistance level up here, big support level down here, and then going into a smaller time frame chart and looking for a reversal at that timing window of 7 o'clock. And so this doesn't happen every day, but when it does, I'm there and I'm able to capture on that move. So instead of following what the market's doing and trying to chase what the market's doing, I'm sitting and I'm waiting for the market to essentially come to me. I have a plan, and then when it does that, I'm able to execute and take advantage of that plan and the move that it potentially has. You want to go into trading with that plan in mind, because otherwise you're just going to be chasing your own tail, and it's not going to work out in the long run. You might have wins here or there, because again, at the end of the day, there's some luck involved. It's trading. You can always make money in the short term. A lot of the ways it's like gambling, right? You can always go into the casino and make money in a day or two, or even a week. But over the long run, the casino is going to win every time, because they have a plan and they consistently execute it the same way every time. That's what you want to think about, like with trading. And so the biggest thing that made me profitable was narrowing my focus and focusing on just reversals. And so I actually have a 14-page free guide you can get that has all my favorite reversal patterns in it. You can get that in the link of this video. And so I've been trading this strategy for years, and through this strategy, I was able to start with a really small account, risking something like $100 per trade. You could even start smaller if you want. You could probably risk $20 per trade at the smallest size. And then, capturing moves like this where you're risking a smaller amount and capturing a larger amount, where I'm getting about $300 on a win here. And so that's about 3 times my risk. And you're able to get in and be able to have a plan and consistently be taking profits off of this. You can see this trade is from 2022, and check this out. 7 o'clock, there's a reversal happening. I'm telling you, it's there. It happens consistently, and you're able to take advantage of it. And now over time, I'm risking way larger amounts. So you can see again, this is another trade, way more recent, 2024. Again, 7 o'clock, I'm looking for a reversal to happen. So it's allowed me to grow that account. And the thing is, what you want to realize is when it comes to trading, you do not need to be taking 10 trades a day. Probably the biggest thing that loses people money trading is falling into that trap of day trading and realizing that you do not need to be making 50 trades a day to be making money day trading. Day trading doesn't mean you're making money every day. It doesn't mean you're taking a trade every day. Day trading just means you're taking a trade on a really small time frame, entering in on that day and getting out on the same day. When it comes to finding that edge in the market, that edge is going to be found only so often. And when you're trading properly, you're sitting there and waiting for the market to come to you to find that opportunity. You're not trying to capture every move and make money every day. If you try and make money every day, you're going to be forcing trades on bad trading days. And you don't want to be doing that. You want to be taking trades only when it fits your plan, because I've tried it where you try and have different plans for different types of trading days or different modes the market's in, have a reversal strategy, have a breakout strategy. And I've realized that, just keep it simple, stick to one strategy and wait for the market to come to you. Take action when it does. And if it doesn't, be done for the day. And so that's why I've started to do this kind of trade where I really only show up for an hour in the morning. Once I start watching the market around 6:30, but I then take a trade, a reversal trade. And then once that happens, I'm done trading for the day, because again, that opportunity is around that 7 o'clock time. And so I only trade for 60 to 90 minutes and then move on with my day. And so that's the biggest thing that has helped me really become way better at this, is having that consistent routine that you just do every day. Trading almost really repetitive and boring, because at the end of the day, that's what makes money trading. It's not here to make you have, an adrenaline rush or anything. It's here to make you money. And so if you want to learn the strategy that I've been using to start to grow an account and, start to be taking massive trades like you can see here, check out this video right here. I go into a full step process on how to start with an account, risking as little as $50, to growing and having a growth process and steps to increase your account size and increase your trading risk size, and as well as a 5-step checklist that you really need to follow to confirm reversals at this 7 o'clock timing. You can't be jumping in to this timing randomly thinking that it will reverse, because that's just a really good way to lose your money consistently.